Have you heard the news? The Federal Reserve just made some major moves that could shake up the economy. After a long period of tightening things up, they're changing course. This shift could impact everything from your savings and the prices you pay at the store to your investment portfolio. So, what's really going on with the US dollar? And what does it all mean for you and me? Let's break it down. First, let's talk about the debt situation. The US is facing a huge fiscal challenge. Just 25 years ago, the national debt was around $6 trillion. Today, it's skyrocketed to over $36 trillion. This massive increase was fueled by things like economic crises and the pandemic response. Now, the interest payments on this debt alone are over $1 trillion a year. To put that in perspective, that's more than we spend on defense or healthcare. Economists are even predicting these interest payments could surpass Social Security costs by 2030. When a government has this much debt, it usually has a few options: restructure it, cut spending, or use monetary policy to manage it. Each path has its own set of economic consequences. This brings us to the Federal Reserve's recent policy shift. They've made two big adjustments. First, they injected $13 billion of liquidity into the banking system. This is the largest injection since 2020 and signals a growing demand for capital, especially in areas like tech infrastructure. Second, the Fed has officially ended its quantitative tightening program. That means they've stopped shrinking their holdings of Treasury bonds, which keeps more money flowing in the financial system. Before the pandemic, the Fed's balance sheet was under $4 trillion. Now, it's over $6.5 trillion. That's an extra $2.5 trillion that will stay in the economy instead of being pulled out. It's a delicate balancing act between fighting inflation and supporting economic growth. So, what's the economic outlook for 2026? Many financial analysts are predicting interest rate cuts. The Treasury is already moving towards issuing shorter-term bonds, and it looks like monetary policy will become more relaxed to help manage the cost of servicing the national debt. Some advisors even suggest rates could drop significantly to keep borrowing costs low and the economy moving. Right now, there's over $8 trillion sitting in money market accounts, earning about 3.5%. If rates fall to 1 or 2%, investors might start moving that money into stocks, crypto, real estate, and commodities like gold and silver. At the same time, inflation is still a concern. Consumer prices are up 3%, and consumer confidence is down. Some economists worry that cutting rates while still running large deficits could spark another round of inflation. What are the real-world implications of all this? For consumers, it could mean prices for everyday goods like groceries continue to climb, stretching your budget further. For savers, returns on savings accounts and money market funds might drop, making it harder to grow your money, especially with inflation sticking around. For investors, those holding assets like stocks, real estate, or precious metals could see their nominal values go up. However, whether that translates to real gains in purchasing power depends on how high inflation goes. This also touches on economic inequality. Not everyone has equal access to appreciating assets. When asset prices rise faster than wages, the wealth gap can widen. And the U.S. already has one of the highest levels of wealth inequality. In the end, economic policymakers are juggling a lot of complex trade-offs, managing debt, controlling inflation, and promoting growth all at once. The current direction points towards more monetary accommodation. Understanding these trends is key to making smart financial decisions for yourself. Stay informed about economic policy. Think about diversifying your financial strategy and consider how these changes might affect your personal finances. Thanks for watching, and be sure to follow for more updates.